Yeah, thank you. So slide also visible, no?
Good evening, sir.
Yes. The PowerPoint
Yes,
slide also visible, right? The
yes,
today class
sir.
is focusing on financial management, right? So again, like international business, financial management also narrow down subject. Narrow down subject means there is a border in which they can ask question. If you take marketing or HR, right, accounting, it has wider syllabus. Even the setter can have uh, multiple thinking and can have different set of questions, even outside the border also. But if you take international business, financial management, income tax, so those things are narrowed down subject, right? So today we will focus on financial management. So what do you mean by financial manager, right? What are the role of financial manager? So that's what usual question used to be. There are two roles. One is treasurer and the other one is controller. So what are the role of treasurer? Who is called as controller? What role he performs? This used to be a set model question, right? So oversees cash management, credit management, approves capital expenditure, right? Capital structure decisions, financial planning, so etc. These are the role of treasurer. So if you say day-to-day business like tax, cost accounting, recording data, bookkeeping, financial accounting, data processing, those things comes under finance controller. Right? This used to be a question in even TN set and other state also when they ask question from financial management. These are the basic question. Then what are the financial management decisions? So it's nothing but it covers the entire syllabus. Financial management decisions. So normally we have four types of decisions. Even we used to call it as finance functions. Right? Finance functions. So what are those? So first one is what is that? Financial structure decision. Financial structure decision, or we can call it as finance function. Second one is investment decision, and then the third one is liquidity decision, and the last one is dividend distribution decision. So altogether, financial management covers these four decisions, four functions of finance. One is financial structure, second one is investment decision, third one is liquidity, the fourth one is dividend decision. The fourth one is dividend decision. The investment decision deals with capital budgeting. The investment decisions deals with capital budgeting. The finance decision, or we can call it as what is that? Finance function or financial planning, etc. So those things comes under what is that? Capital structure. Everything comes under finance decision. Right? The working capital management, receivable management, inventory management, those things comes in liquidity management. The last one is profit distribution. So whether to distribute or not. If yes, how much it could be, or everything should be retained. So those things called as dividend decision. So what is the goal of financial management? This is the basic question. Intro part. What is the goal of financial management? Either to maximize profit or minimize cost. This used to be a basic question, minimizing cost or maximization of profit. The first and foremost goal we used to say maximize profit maximization. Profit maximization. When we study UG and PG, it used to be a question, right? Explain the goal of financial management. The profit maximization is the primary goal, and there were heavy criticism on profit maximization. Then the second structure came is called as what is that? Wealth maximization. Wealth maximization is nothing but maximizing the market share value, maximizing the market share value. It's called wealth maximization. Or the other way, maximize the current value of the company's shares. Right? Is that the market value or the share value? So those things comes under wealth maximization. Wealth refers to asset of the company. So increasing the worth of the company, net worth value of the company is called wealth maximization. So profit maximization, there were heavy critics. The reason is that it's not business alone. Financial management something beyond, right? So wealth maximization should be the priority. So that's how it has moved. Then later in the IFRS, International Finance Reporting Act, what it says is we need to focus on Sarbanes-Oxley Act. SO Act is along Sarbanes-Oxley Act, which means it deals with presenting the financial statement in such a way to maximization of wealth. The financial, if you prepare an IFR, what is the International Financial Report, according to IFRS, International Financial Report Standard, the entire financial statement reflects how the particular, how an organization in a particular period able to maximize its wealth. If is it or not, how far it is, that can be seen in the by using Sarbanes-Oxley. It displays an important role. Once it was asked, wealth maximization basically, IFRS suggesting an act to present your financial statement, what it is, we get on that. So Sarbanes-Oxley Act. So as I discussed earlier, as I said earlier, finance function can be carried out by 4 decisions. So here one arrow mark is missing in the statement. It is not that missing. It included in 2 decisions. That's why here it is not referred. So finance function has finance decision, investment decision, liquidity decision. The third one is profit allocation decision. Is called as dividend decision. Right? Financial decision comes, we deal with the capital structure, cost of capital. Investment decisions purely on capital budgeting, purely on capital budgeting techniques. Right? Liquidity decision, it has 3 components: working capital management, receivable management, inventory management. Right. The last one, profit allocation decision, is the dividend distribution of dividend. Right. So that's how the entire financial management talks about. This altogether is called as fund management science. So this flow chart helps us to understand how to maximize the wealth.
Right?
From the profit maximization perspective. If you take profit maximization perspective, it talks mostly on business risk, which means it includes economic risk and operational risk. When you cover the wealth maximization as a goal, then we need to consider financial risk too. Right? So for foreseeing the economic risk, there are 4 factors. One is economic condition, political environment. These are external. And then market structure and competitive position of the firm. These things to be, we can say it's controllable, right, under economic risk. So if you take operational risk, this economic risk makes you to do your turnover. So from the turnover, converting the turnover into EBIT, earnings before interest and tax. So that is called operational risk. So from the earnings before interest and tax and converting that into earnings after tax and converting that earnings after tax into earnings per share. So this includes financial risk. Right? Financial risk. At last, the creation of EPS, earning per share, is called as value creation. Right? Here we can analyze the wealth maximization. Is that happened or not? It is an important flow chart. Once it was asked about business risk does not deal with dash negative line, so answer was financial risk. right? அதே மாதிரி the மூணு risk கொடுத்துட்டு match the following கேட்டிருந்தாங்க. So you can match. So economic risk deals with either one, it used to come. Operational risk deals with EBIT, converting into EBIT. Financial risk deals with conversion of EBIT into EAT, earnings after tax, etc. So it is one important concept in the introduction, risk return paradox. Risk return paradox in the financial management, it used to be net management and the questions are wrong. Of course, commerce then how it plays an important role. See, it starts with various factors. It starts with various factors, right? And that those factors are converted into two ways. One is increasing your revenue, that means through profitability, that means your effectiveness, and the other way, minimizing the risk. Minimizing the risk. Though both are contradictory, but the financial management decision helps you to balance these two. This is called risk return paradox. This circle is called risk return paradox. It used to be a bell-shaped curve, but somewhere it used to be equilibrate. Somewhere it used to be equilibrate. The equilibrate பண்றதுக்கு the financial management decision helps us. The financial management decision helps us to balance these two. எந்த இடத்துல increase இல்லாம decrease இல்லாம equilibration ஆகுது, that point is called as risk return trade-off point. Risk return trade-off point. If you meet the risk return trade-off point at one level, then that level is called as wealth maximization level, where your organization can increase your wealth or enhance the value of the firm. EVA, we used to call it as EVA, economic value added, enhancing the value of the firm. Economic value added, not a framework. What is that? It will come from, it will come next year. So this structure helps us to understand the four decisions. What are the four decisions? As I said, finance decision, investment decision, liquidity decision, and dividend decision. So if you take that, if you take any financial statement, take balance sheet for example. So this is a balance sheet of a company format. Then the first part in the liability side, half of the part deals with capital structure and cost of capital. The second part deals with working capital management. And the third part, which means the first part of the asset side, deals with capital budgeting, portfolio management. And the second part in the balance sheet, the last part, second part in the asset side, all the current assets, deals with cash management, credit management, inventory management. So if you summarize, you can get three functions performed by using this financial statement, right? So three functions, financing function, investment function, and liquidity function, right? Only the dividend function excluded from the financial statement. Here, this flow chart, this helps us to understand how it plays an important role: capital structure, financing decision, investment decision, capital budgeting, and liquidity decision is working capital management. So these three, how it plays in the balance sheet, how it plays a role, right? From where it starts, how it helps us to maximize. This is called balance sheet model of a firm studying through traditional approach. Then if you take income statement, you take an income statement, which means the profit and loss account. So the focus on future decision based on accounting financial statements. So which means the revenue risk, financial risk, business risk, operational risk, and the last function which we have left in the financial management function, dividend function, it plays here at last, right? So everything it deals in the income statement. If you break the income statement and balance sheet, if you take the financial statement and break each and everything according to financial management functions, then you can understand better. So it can be in match the following level, statement validation formula, direct choose the best answer level. Right. Please go through that. So if you take this statement, this is the role of controller. If you see the previous statement, this is the role of treasurer. Role of treasurer. This is this balance sheet role of treasurer. If you take this income statement, role of controller. So likewise you can understand. So this flow chart helps us to understand how it plays, how the entire activity plays. So point number one, financial market. It starts point number one, which means cash raised from the investor by issuing prospectus, right? Share capital or debentures. They're raising share fundraising. Second step, financial manager to the finance firm's operation. It goes to firm's operation. That means it comes as investment. Then if you take in return from the investment of the business, you will get return. This is called EBIT, profit after tax, etc. Then some amount used to be reinvested. It is called the retained earnings. Point number four. Cash reinvested is called as retained earnings. Otherwise, again, it goes back to the investors as either as dividend or interest. Right? This is called the return to share, return to investors. Right? So from the firm's operation directly, some amount goes out. So this is called tax to government. Right? So likewise, the finance plays a role. Next, this is called economic value added. This is a concept where we used to deal with wealth maximization of an organization. Here, why do we call it as economic value added, EVA concept, right? Why means the wealth maximization of an organization leads to the development of the economy of a nation. Right? So this is an economic perspective approach that we used to see how the economic value added process gets into an organization through wealth maximization. So earlier, as a traditional approach, we used to measure the shareholders' value. That is called the wealth maximization. But nowadays, in an extensive to the equity research, now they established it is not earnings alone, earnings per se alone. The value is most important. So that's why the new measure called economic value added is increasingly being applied to understand and evaluate the financial performance of an organization. So if you take any grading sheet or a checklist of any firm, the framework they used to have no CAP framework. There are different scales are there for lending, for credit appraisal. They used to follow only the economic value added. They used to evaluate the financial performance through this. Right? So economic value added simply they used to call it as net operating profit after tax. That means EAT. EAT minus cost of capital employed. So whatever remains, that's called as net economic value added. That's called as economic value added. Right? So we know what is net operating profit after tax. That's nothing but earnings after tax. Cost of capital means it's a weighted average cost of capital. The weighted average cost of capital. Right? So recall the four functions of finance. So what are those? Yeah. So whatever we have discussed, financing function, investment function, liquidity function, dividend function, it used to play an important role through the financial manager, right? So which are the short term, which are the long term, right? Which has both which has a role to play in both short term and long term. Likewise, we need to explore. So investment decision plays first. Can you see? And yeah. Next, finance function. We have already discussed this, right? So we need to know what are the investment function is related to long-term asset mix decision, which means capital budgeting. Financing refers to capital mix decision, which means the capital structure and cost of capital calculation, everything it comes, weighted average cost of capital. Everything comes in financing decision. Dividend decision means profit allocation decision, liquidity decision, which refers to short-term asset mix decision related to working capital management, cash management, receivable management, and inventory management. This is as a whole. Now we are going to discuss one by one, right? The first one is financing decision. So here we used to call it as called capital structure theory and cost of capital. So these two parts we used to discuss under financing decision. Right? Capital structure theories and cost of capital. So capital structure theories on the separate. Every time there used to be a question. Right? So what do you mean by capital structure? What do you call it as capital structure in a company? Because everything, whatever here we discuss is from the company perspective. It's not from partnership firm, or no, it's not from sole trader, or it's not from cooperative. You can assume, based on, but theory is the same. You can assume from the other organization perspective also. But whenever we deal with subject, it used to be from company perspective, where share capital, preference share capital, equity, debenture, likewise, these terms we used to discuss, bonds, right? Yes. So what does the capital structure mean? Yeah, it is the capital mix, a combination of debt and equity. A combination of debt and equity. So we have seen a solvency, a part of solvency ratio, we have seen debt equity ratio. Yeah, do you remember that? Yes, that's called capital structure. So how do we have? So what is the proportion could be the equity and debt, external debt and internal finance. So what proportion could be? That's called capital structure, right? So rising of capital from different sources and their uses in different assets by a company is made on the basis of certain principles. So either to have more equity and less debt, it has some principles. Or some ways, some other firm used to have more debt, but they used to have less equity. But they also have some principles. So, but the result should be maximum rate of return can be earned at the minimum cost. That is the optimum capital structure we used to say. What is called as optimum capital structure, where you can give maximum rate of return with minimum cost. Minimum cost means not in manufacturing, not in production. Here, minimum cost means to pay interest, to pay dividend. Yeah, that's called cost. But we need to have maximum rate of return. So how it can be balanced. So that is called the study of capital structure. So for this, there are different theories they have suggested. So total required capital you can consider from the own fund and outsider fund. Own fund you can call it as equity share capital and preference share capital. From the outsider fund it can be called as debentures, bonds, right? Public debts, right? In general you can call it as public debts. So what are the factors influencing capital structure? Next part. This is theoretically descriptive theory part, but it can be expected through assertion and reason model, through statement validation model, right? So if you take internal factors, so why does operating ratio comes in as an internal factor? How it affects the capital structure, right? For example, next age of the firm, how it affects the capital structure through as an internal factor. So likewise, we need to study each and everything. Right? I don't want to explain everything, but let us have what is trading on equity. That's most important. Trading on equity. This used to be a repeated question. This is an internal factor, which means trading on equity. They used to balance the debt portion. Sometimes they used to issue shares. Sometimes they used to issue preference share capital, or sometimes debentures. Right? They used to play. They used to play on the financing decision, which we call it as the play means it's not game. They used to take an important role in mixing the both debt and equity. Right? Trading on equity means making the owners to have more returns through which mix through debt and equity mix. How it works. That's called the trading on equity. So we need to please get into the descriptive part from your own textbook, whatever you prefer, whatever you use regularly. Then external factors, how it helps. External factors, right? Where this helps us to attend this statement validation question model, assertion reason question model, etc. Then what is optimal capital structure? Yeah, as I said earlier, maximum rate of return at the minimum cost. So here, how do we define that? So the best capital structure is called as optimal capital structure is called as best capital structure, which means it's most economical and safe ratio. This means it's the most economical and safe ratio between various types of securities. It's purely on mix of debt and equity, which maximizes the value of the company and minimizes the cost of capital. Right? That's what we discussed: maximum return on investment and the minimum cost. Right? Then, what are the factors influencing the optimal capital structure? The sound of the firm, capital mix. Right? These are the theoretical part. Please go through. Then theories, theories of capital. These are called as capital structure theories. So there are what are the theories? Do we know? Relevant model, irrelevant model, net income, traditional approach, Modigliani-Miller approach. There are different theories, right? So let us see one by one. First one is net income theory. Net income theory. It is propounded by David Turant. Now, twice it has asked in set examiner, but in net examiner match the following, like the net income theory is one side, the other side David Turant was there. If you know this, then you can match. So this theory is also called as fixed key theory. Fixed key theory. Yeah, please. The K refers to what is that? The Greek term cost of equity. The K refers to is the Greek letter of cost of equity. So fixed cost of equity. Simply you can say fixed cost of equity. Right? So from this theory, what they trying to say, a firm can increase the value of the firm. So all the theories, whatever the theory we discussed, this focus on increasing the value of the firm. Please remember that, because everything works on wealth maximization. But all the theories has different principle, different assumption on which it works, right? It is based on the perception of the propounder who said that. For example, David Turant has his own assumption on which he says value of the firm can be increased if you follow his method. Yeah? If you follow his theory, that's what he says. But at the same time, Modi Cleary Miller will have different approach. He will say under these assumptions, this framework only will work to increase the value of the firm. So likewise, everyone has come out with different theories. Yeah, here, from the David Turant perspective, a firm can increase the value of the firm and reduce the overall cost of capital. Please make an underline by increasing the proportion of debt in its capital structure to the maximum possible extent. So what he says, increase the debt proportion. If it is 1:1 debt and equity, then increase the debt proportion to the maximum extent, which means you can't be 0 is to debt alone full form, it can't be. But to the maximum extent, you need to increase the debt. That's what the David Turant suggests. Right? Why he says? Because he says and two important things. One is interest rate are lower than the dividend rates. So when you have to share the profit to the owners, to the shareholders, the dividend rate used to be more than the interest rate. Interest rate is always fixed. So long-term sustaining firms need to have more debt portfolio than the equity portfolio. Second is the benefit of tax. When you pay interest, you can claim the tax amount, right? You no need to. But when you pay the dividend, you need to pay the tax for the dividend also, because that becomes a part of your profit, right? So benefit of tax is available in the case of interest payment. So which is called as deductible expenses from the income tax purpose. So these two advantages we have to follow his theory, yeah, fixed the cost of equity theory. How to compute the value of the firm. So mostly the sums point of view, it has been asked rarely, but it has been asked. Net exam day, they have asked to find out the value of the firm, right? So what is the if you know to solve the sum conceptually, I won't say it is a mathematically solve that won't be that. We used to be in UG PG mathematics, but conceptually if you understand to solve the sum, then you can easily remember the assumptions, and then what is the purpose of the theory. Everything you can remember if you understand conceptually how to calculate the value of the firm, right? எப்படி சார் கான்செப்டுவலினா என்ன சொல்ல வரீங்கன்னா, நம்ம மேத்தமெட்டிக்கலா என்ன பண்ணுவோம்னா சிம்பிளி வி யூஸ் டு பிளைண்டா நம்ம என்ன பண்ணுவோம்னா s is equal to EB80 minus I divided by KE னு போடுவோம். So why do we divide by KE, cost of equity? Why do we say it as A, yes, or EB80 minus interest? Why do we exclude the interest? அந்த மாதிரிலாம் we need to understand, right? Interest எதுக்கு exclude பண்றோம்? To divide the value of the share. Those things we need to understand. Then only we can understand what is the purpose of the theory and what are the assumption it has. நம்ம மெமரைஸ் பண்ண தேவையில்ல. இதை நம்ம நல்லா கான்செப்டுவல் அண்டர்ஸ்டாண்ட் பண்ணாலே we can easily remember the concepts and assumptions, right? So here what they say is value of the firm is equal to market value of share and market value of debentures, market value of debt in altogether. Debenture இருக்கலாம், bond இருக்கலாம், right? Public debt இருக்கலாம், public issues இருக்கலாம். So it can altogether is called a debt. So market value of share plus market value of debenture altogether, if you add these two, you will get value of the firm. So here market value of the share is denoted by S, which means EBIT minus interest divided by cost of equity. The EBIT will the interest now balance related to whom it is. Yeah, it goes to earnings to the shareholders. That's why we are subtracting. The earnings to the shareholders divided by cost of equity. You will get value of shares, market value of shares. Then market value of debt is as usual. You no need to calculate because it is a fixed interest. Now, இதே format put calculate பண்ணாலும் you will get the same amount. What is the face value? Take that as it is, right? Then what does the E refer? The earning, yeah, that I already said no. Yeah, this is yeah. So the KE refers to cost of equity or otherwise equity capitalization rate. Next, computation of overall cost of capitalization. KO means overall cost of capital. Overall cost of capital is equal to EBIT divided by value of the firm. So which we have calculated here. So what we got here as an amount. So calculate EBIT divided by value of the firm into 100. You will get overall cost of the capital, right? Or capitalization rate. So for example, there is a small sum. So you can later you can apply this sum to solve the sum to solve, right? So that why I am giving this won't be asked directly, but if you solve mathematically and understand the concept, you can remember the assumptions and purpose of the theory, right? Why do they say net income approach, right? The next theory is called as net operating income theory. So this theory is proposed by again David Thuran. So David Thuran has given net income approach, net income theory, and the other one is net operating income theory. NOI is net operating income theory. So this theory is also known as irrelevant theory. Right? Which means the total market value of the firm is not affected by change in the capital structure. That's what it says. Net income theory, what he says, the David Thuran both are same, but he under this assumption this will work out, right? If it is not going to be relevant, which means irrelevant, then this theory will be worked out. If it is relevant, the capital mix decision is always decides the value of the firm. If that is the case, then net income theory will work out. So accordingly, you need to remember this, right? Irrespective of debt equity mix, the value of the firm never changes. In such a case, we can follow net operating income theory. Please remember the theory part, right? So what are the assumptions of net operating income theory, right? So if it is not affected, then what are the assumptions you can think of? If you can think of, you will get a few points. So it will affect if the debt and equity mix will not affect the value of the firm, then what are the assumptions could be? Then you will get. Then if you study this, you can remember, right? So please go through that. So always most of the theory around the corporate tax does not exist in world. Corporate tax, which means they assume that it is nil. It can't be nil in practice, but they assume that if it is nil, you apply this theory, right? So here, if it is irrelevant and the net operating income approach, then you need to calculate value of the firm in this formula, right? So it is a reverse order. It is in reverse order. Now, net income approach we calculated in the direct way. We calculated value, market share value, then market depth value, then added both as a value of the firm, then taken the value of the firm to find out the overall cost of capital. But here, what we are saying, it will not affect the value of the sum. So cost of capital, overall cost of capital, or what is that? Capitalization rate. Overall capitalization rate will not change. So that's why here we are directly calculating value of the firm is equal to EBIT divided by overall cost of capital, right? So here in reverse, first but in the net operating income theory, we should calculate first value of the firm. Then from them, share value will be calculated. Market value of the share will be calculated. It's equal to value of the firm minus debt value. Right? So likewise, the market share value will be calculated and the net operating income approach. Right? Then what is the cost of equity? So cost of equity is also calculated. Next, after calculating value of the equity, market share value of the equity. Right? It is in reverse order. The third theory is called the traditional theory. Now, did you understand these two theories? Net income and net operating income. Good. So next is traditional theory. It is called as what is that? It's propounded by Esther Solomon. Please make a note. Here, what he says, a firm can reduce the overall cost of capital or increase the total value of the firm by increasing the debt proportion in its capital structure to a certain limit, because debt is a cheap source of rising funds as compared to equity capital. So mostly the net income theory and traditional theory both are similar, right? Yeah. So here what he says, effect of changes in capital structure and overall cost of equity and value of the firm. So he says in different order, first stage, second stage, in first stage what he says, use of debt in capital structure increases the value of the firm and decreases the overall cost of equity, cost of capital, overall cost of capital. Here the basic assumption is cost of equity remains constant, right? Even if it changes, it will not be huge. Very insignificant changes will not happen, right? So cost of debt is also remains constant or rises very negligibly. Right? So second stage, during this stage, there is a range in which the value of the firm will be maximum and cost of capital will be minimum, because the increase in the cost of equity due to increase in financial risk to offset the advantages of using low cost debt. Right? This is the second stage. So it can be asked in match the following: first stage, second stage, third stage. Right? In the third stage, the V, which means the value of the firm will decrease and the cost of capital, overall cost of capital will increase in the third stage. The first stage, what is the stage? How it works? The value of the firm and overall cost of capital, cost of equity, and cost of debt. Second stage, how it works. Third stage, how it works. That's what we need to go through in this theory, right? Traditional theory, Solomon theory, Esther Solomon, right? So please go through the mathematical equation part. The fourth theory is Modigliani-Miller theory, MM theory. Yeah. MM theory. Please go have the full name. There are two persons. Franco Modigliani is one person. The other one is Merton Miller is the other person. எதுக்கு நான் சொல்றேன்னா நமக்கு நேம் வந்து full name கூட கொடுத்து வந்துச்சுன்னா we will get confused. Always we used to study MM approach, MM theory. But when you come across the full name, any option you may confuse. You may get you may choose. You may induce you to choose the wrong answer, right? So Franco Modigliani and Merton Miller. Please have the name. Remember the name. So there are two approaches. What he says, in the absence of corporate tax, how it works. If the corporate tax exists, then how it works. So likewise, he gives two approaches. Right? What he says, in the absence of In the absence of corporate tax, it works as per the net operating income theory. In the presence of corporate tax, it works as per the net income theory. That's what he says, right? From his theory. Please go through that. So for his, he has some assumptions. The assumptions, Robovati questions like net exam, right? So please go through that. Okay. This theory which we never used to come across in our UG or PG. There is a least chance. There is a theory called a least trade-off theory. It comes in MM theory criticism. There are different theory have been evolved, right? So trade-off theory. MM theory ignores bankruptcy, financial distress on the it ignores. So if you have the financial distress, that means the cost of finance. The cost of finance, then you need to balance the trade. That means we used to balance the risk and return. Risk and return. That's called a trade-off theory, right? That's what we say is that optimal capital structure exists, that the balance of these cost and benefit. Then there is another theory called signaling theory. The Modigliani-Miller approach always assumes that the investor and manager have the same information. But in reality, it's not so. In reality, manager often have better information than the investor. So what they used to do, they used to sell their stock if the stock is overvalued. Another market value அதிகமா இருக்கிறப்ப they will sell. அதே மாதிரி they will sell their bonds if the stock is undervalued. Share value ரொம்ப கம்மியா இருக்குன்னா they will issue debentures. They will sell their debentures, public bonds. Okay, so managers knows better than the investor. So accordingly, the manager will work out, right? So in this case, we need to understand the market from the company's perspective. Investor understand this, so view new stock sales as a negative signal. Shares issue understanding it is a negative signal. So this is called signaling. Signaling. Right? So till now we have dealt about capital structure, how it works, capital structure theories, and approaches to capital structure. The second part in the finance, what is that? Financing function, financing decision. Second part is cost of capital. So cost of capital means it has, there are varieties: equity share capital, preference share capital, debenture. So everything you will have separate cost. Cost of equity, cost of preference share, KP nu solluvom, then cost of debt ku KD nu solluvom. Capital letter K and small letter P, KD, cost of debt, and then cost of retained earnings, KR. These all together is called as overall cost of capital. Right? Overall cost of capital. This overall cost of capital used to be calculated by applying weighted average cost of capital method, WACC. You remember these things? My paper cost of capital calculation, right? So I am going to start from the weighted average cost of capital. So we are going to discuss. I am going to start from the weighted average cost of capital, because believing that you know the basics, right? Cost of equity, cost of debt, cost of preference share, cost of retained earnings. அதெல்லாமே நம்ம ஒரு approach based பண்ணி calculate பண்ணுவோம். Cost of equity வந்து what is that? Growth approach, price plus growth approach is one. Then price model, dividend price model, market price model, and then dividend price plus growth approach, right? IRR model, and different models are there to calculate cost of equity, cost of debt. Interest now, no other model, only direct calculation. So everything when you calculate, last we need to calculate weighted average cost of capital. So if you take a balance sheet, right? Current assets, fixed assets, it used to be, and then liabilities, right? And then fixed liabilities. So altogether, if you take the long-term debts and equity, this is the 4,000, 1,000, 5,000, totally $10,000. It has been mentioned here, right? Liabilities, bonds, preferred stock, and common stock. So what is the term bond? What is that? 4,000. 4,000 preferred stock, 1,000 common stock, 5,000. So altogether it's 10,000, right? If you take proportion, so it comes about 40%, 10%, 50%. So what is the rate of interest on the bonds, right? So 10%. For the preference share capital, we used to call it as preferred stock, right? Preference share capital, 10%. Then common stock is called as equity share capital. So this carries 13%. These are called a dividend rate. For bonds, it's called as interest rate. So have the proportion and the rate, return rate percentage, right? Now what we need to do, calculate the return with the proportion. So 10% multiply with 40%. And then preference share capital 10% multiply with the proportion. So if you multiply, can you see here the workings? Weighted average. And then what is that? For each thing we used to calculate. At last we will get weighted average cost of capital 11.09%. That means KO, overall cost of capital, is 11.09%. Right? So likewise we need to calculate the overall weighted average cost of capital. So if you see a line, yeah, there is an important point which never asked in NET exam, but we need to, but this is expected, right? Break-even point. break-even point in cost of capital curve. Break-in cost of capital curve. So there is a small equation. Right? Please go through that. Yeah. How it applies. Now, this is another example of how it applies. It works out. Right? Please go through that. Break-even point in cost of capital. So, if IRR is more than the cost of capital, it can be accepted. If the IRR is less than the cost of capital, it has to be rejected. But there is a two project it comes. So one project one says something like issue of shares this much, debenture this much, you will get IRR 12.4. Project two says different portfolio of equity and debentures, so you will get different percentage of return IRR. So if it is less than the overall cost of capital, then it has to be rejected. If it is more than the overall cost of capital, then it can be accepted. Right? That's why we need to work out. Right? This can be asked in the forthcoming net exam. Right? So this is all called as financing decisions. The second part, second function, we used to call it as investment decision. This we used to deal in capital budgeting. This we used to deal in capital budgeting. Yes. So investment decision is all about capital budgeting. Right? Just wait a second, wait a minute, I will get back. Yes. Okay. So capital budgeting is a part of investment decision. Capital budgeting. Yeah. So what is capital budgeting? What are the steps it has? That's most important. Capital budgeting in general we know, but what is capital budgeting? What are the steps it has? Right. So what are the methods we have? Discounted cash flow method, non-discounted cash flow method, discounted cash flow method like payback period, post payback profitability, accounting rate of return. These are called as non-discounted cash flow method. Right? Discounted cash flow techniques like net present value method, profitability index, internal rate of return, profitability index layer under the gross profitability index, net profitability index. Right? Here the main thing is why do we call it as discounted cash flow and why this category is called as non-discounted cash flow. Non-discounted cash flow means where we will not consider the time value of money. So future money is equal to today's money. So which means I did not consider the time value of money. No, it is not so. Today's money is better than the future's money. நீ 2 வருஷம் கழிச்சு வாங்க போற 10,000 இப்போ இருக்கிற 10,000 ஒன்னா நினைச்சோம்னா then it is called non discounted cash. இன்னும் both are different. 2 வருஷம் கழிச்சு வாங்க போறது 2 வருஷம் கழிச்சு வாங்குறப்ப அதோட ஒர்த் கம்மியா இருக்கும், right? Then it is called discounted cash flow. So all the future cash flows used to be discounted based on the time value of money. We used to call in short form, we used to say TVM, time value of money. So time value of money, if we consider the time value of money, then we need to apply discounted cash flow techniques. Right? So capital budgeting techniques, these are the 5 steps. Project evaluation and selection. In the first steps itself, we used to end up our classes. Normally in UG, PG, when we start, when we have the capital budgeting, first step we used to, we used to start, right? Sum we used to solve the sums by applying different methods. So it comes in only in step 1, project evaluation and selection. Second step, potential difficulties that we need to analyze. Risk and uncertainties in capital budgeting. Here also there are different methods apart from what we discussed earlier, discounted, non-discounted method. There are different methods in second step also, risk and uncertainties considered. The third step is capital raising. Capital raising is an important concept. These are the questions kept, right? And then project monitoring. The last one is project completion audit. Yeah, that's what we are going to discuss now. So proposed project data. For example, one case, small case has been given here. Julie Miller is evaluating a new project. It's called as Basket Wonders. So there are different cash flows in the different 5 years. 5 years, 10,000, 12,000, 15,000. There are different cash flows. But see, you need to invest 40,000 at the first year, in the first year before starting the business. They need to invest 40,000. So every year they used to get different cash flows. Then which are the method can be applied, right? So what we used to say, there is a 2 options. One is dependent and independent project. Independent project means the acceptance or rejection does not prevent the acceptance of other project. This is called independent project, right? Dependent project now, if you have A, B, C, D for proposal, if you accept A, it affects the B project or C project, right? If out of 4 projects, 3 projects are profitable in different extent, then we need to rationate our investment amount, available amount. So during that time, it becomes as a dependent project. So we need to understand what is independent and what is dependent. Independent project, it is easy to apply the capital budgeting. If there is a dependent, then we need to apply capital rationing concept. Then what is payback period? We know what is the time required to get back our investment amount as a cumulative expected cash flow, right? So here we never apply any time value of money. We directly calculate what is the cumulative amount, cash daily, annual cash inflow. We will put up, we will prepare it every day. Do you remember that? Number of years and then annual cash inflow, then cumulative value of cash inflows. Just we will add. Then we will calculate what is the, where we are getting back our total amount, right? That means 40,000 years. So first year we are getting 10,000, second year 12,000, third year 15,000, then cumulative we will get first year 10,000, second year 22, third year 37, fourth year we will get 47,000. But here we need only 40,000. So we are getting back our amount between 3 to 4th year, third year to 4th year, which means we will get back our amount approximately 3.3 years, right? Or 3 years, 4 months, right? So this is called a payback period we used to see, right? And then so the project is acceptable. So as per the industrial standard, they used to have, the company used to have a standard 3.5 years the project would be best. So as per the sum, we have only 3.3 years, less than the expected, which means we can accept the project, right? So it is called rejection or acceptance criteria. So here acceptance criteria is check the company status or industrial standard, and if it is less than the industrial or company standard, then you can very well accept. In the matter question to conceptual net exam. So payback period can be acceptable less than the company standard or more than the company standard or equal to company standard. In the situation you can accept. Option வந்து வெரியா இருக்கும். A and B, B and C அந்த மாதிரி mix ஆயிருக்கும். Then we can accept if it is less than the company standard or equal to company standard. If it is more than the company standard, we should reject that payback. Right? Then payback period is strength and weakness. Please go, please have that, right? It is easy to understand, it is easy to use, simple, even the illiterate also can use what is that? A petty shop owner can use that payback period, right? If they don't need to have any financial management background. Right? Then what are the weaknesses we have? It does not account the time value of money. This is the basic weakness, right? As out of these three, anything you take, time value of money does not apply, so it is a big weakness, right? There is no cutoff. The cutoff period, which we said 3.5 years. This is on our example, 3.5 years. If they were a company, it used to be 5 years, or if they were a company, 4 years. So the company 2 years, under the company standard model. How do they fix that standard? It is not objective, it is subjective. It is subjective. Subjective na over ஆட்களுக்கு ஏத்த மாதிரி ஒன்னு மாறும். Objective na எல்லாத்துக்குமே ஒண்ணுதான், right? சில பேர் சொல்லுவாங்க objective evaluation நடக்கல அப்படினு சொல்லுவாங்க. When I did not get my expected mark, then I used to say evaluation is purely on subjective. It is not objective, which means subjective means according to the valuer they will put mark. It is not according to the subject, right? According to the subjective means they will frame some verifiable framework, then accordingly they will value. So here the weakness is the craft period is subjective, right? So likewise, please go through. The next one is discounted cash flow technique. The same way we need to apply the payback period, money payback profitability. Payback profitability, how to apply? Total 3.3 years. So what is the total period? 5 years. So out of 5 years, 3.3 is the payback period. So remaining 1.7 years is the payback profitability. Are you able to compare this? Payback period and payback profitability. Right? ARR is very simple. So calculate the net return divided by the initial investment into 100. Calculate. Right? So why do we call it as ARR? Because here it is accounting profit. Accounting profit is considered as return. It's considered as cash flows, right? That's why here we call it as accounting rate of return, right? All other method we used to consider only the cash inflow, but only in here we used to consider the accounting profit, which we used to reflect in profit and loss account. Right? Okay, so please go through that. The next category is discounted cash flow technique. Discounted cash flow technique, which means we used to consider the time value of money. Under this, there are three methods: net present value method, IRR, and profitability index. Over what you the NPV, IRR, which questions conceptual கேக்குறாங்க. ஏதாவது அவனே percentage கொடுத்துருவான், whether to accept or not, அந்த மாதிரி கூட கேட்பான். So direct calculation, right? Even calculation is also simple, which seems to be we no need to be have a huge mathematical equation, right? IRR padama, there used to be an equation. You don't need to have that. If you have the conceptual understanding, you can easily find out. Right? So what is the net PV, net present value? Calculate the present value of the entire inflows and minus present value of outflows. You will get NPV, right? Here the acceptance criterion. Over method we need to have the acceptance criterion. If the NPV is greater than 0, if the NPV is greater than 0, greater than or equal to 0, or we can say if it is positive, then accept the project. Otherwise, reject the project. Right? So you can calculate NPV in the equation form also. Please don't get confused with that. This formula. It's very simple. K refers to the cost, which means rate or right? So here power 1, power 2 potadalame number of years. So here is nothing but time value of money has been put up in the equation form. Right? Annuity equation simple. 1 divided by 1 plus r power n. N means a number of years. That's base pani potukan, but don't need to confuse. Ena namakku nama descriptive exam eludhrappa nama UG PG la ellame they used to give the present value of cash inflow of rupee 1 adinu munnade kuduthirpaanga, right? 0.93, 983, 0.827 அப்படிலாம் கொடுத்துருப்பாங்க. நம்மளுக்கு year 1 year 2 year 3 கொடுத்துருப்பாங்க. அதான் இந்த ஈக்குவேஷன்ல போட்டிருக்காங்க. You no need to worry about this, right? So we can calculate NPV by using the same example which we have stated here. Okay. Then NPV acceptance and rejection criterion. So in this sum, what we have got, NPV is minus. If you put up a table, you follow your pattern which we used to calculate NPV in your exam. Even I used to follow a tabular form. Here, cash inflow, and then present value of cash inflow rupee 1, and the fourth column is multiply cash inflow and rupee value. If you multiply, you will get present value of cash inflow. Then altogether, if you add, you will get gross present value. Then subtract the initial investment, you will get net present value. Then the net present value is more than 0 or equal to 0. Then accept the project. So in this sum, what happens? It is minus 1,428. Minus 4,428. So they have applied, instead of making a table, they have applied the equation, this equation. Right? So either way, you will get the same answer. So minus 1,428. Since it is minus, which means less than the 0, here the acceptance criterion is, so the project is accepted. No. The NPV is negative. This means that the project is reducing shareholders' wealth. So we need to reject this proposal under NPV concept, under NPV technique. Right? So what are the strengths and weaknesses of NPV? So please go through that. And then NPV strength and weakness, pros and cons, right? So you can, this chart helps you to understand what is IRR and NPV. Do you know what is IRR? IRR is a point at which the NPV becomes 0. IRR point, internal rate of return, it is a rate fixed internally in such a way that the expected net present value of the proposed project is 0. Right? Is 0. So for example, we got minus 1,000. What is that? Yeah, minus 1,428. This 1,428. We taken 13% as time value of money, which means rate cost of capital, right? 13%. So 13% is the minus level. We will get 0. Then that point is called as IRR. That percentage is called as IRR. Are you getting my point? Yeah. IRR is a point where the NPV becomes 0, always 0, right? So keep that in mind and understand this structure now. So if you draw the line, right? So 13% NPV, it has gone into negative. It has gone into 1,000 minus 1,400, something it has come down. So it has gone into negative. So if you calculate it different rate, so these are called in present value and discount rate. If you calculate at different rates, there is at one point it becomes 0. This 0 point is called as IRR. So at which point it has become 0? It becomes 0 at between 12 and 15%. So in this point, the rate is called as IRR. So 12 to 15, which means about 13 to 15, 13 to 14. So that percentage you can consider it as not 13 to 14, 12 to 13. Yeah, that percentage can be called as IRR. So if you calculate profitability index next. Remember that IRR assumptions and IRR concept, NPV, we need to compare this. What is the relationship between these two? Okay, right? And did you understand? Profitability index. The next one is profitability index. So what is profitability index? It has the direct relationship between NPV and profitability index. Both are same. If you apply, we will get similar decision. We will get similar decision. Okay? So for example, if the profitability index is more than or equal to 1, if it is more than or equal to 1, then the project can be accepted. If it is less than 1, then it has to be rejected. So profitability index, am I clear? So in profitability index, there are two. One is gross profitability index and the other one is net profitability index. So here in general, if you say profitability index, it always refers to net profitability index. Right? So you can calculate as usual in the table form. In the table form, you will get the same answer, right? So let us get into the IRR. So IRR is most important. Please go through the theory part, right? Particularly the last line. The entire four line helps us to attend the assessment reason model question and what is that? Value statement validation model. IRR, NPV, which there are repeated questions, repeated questions most times. Please go through and take down these important lines. I'll get back in 1 minute, right? Yeah. Do you have any doubt as of now? Do you have any doubt as of now? Yes. Yes. Please go through the gist part also. I will send you that. So as I said, IRR is the discount rate that equates the present value of the future net cash flow from an investment project with the project's initial cash flow. Right? Is the discount rate equates the present value, which will equal the NPV becomes zero. Equates nale, the NPV becomes zero. Total cash flow minus initial investment. அது ரெண்டுமே ஈக்குவலா இருந்தோம்னா NPV becomes zero. அதான் இது சொல்றாங்க. Please go through that. Yeah, go through this exercise. This is not either directly the sums part. Right. Net IRR increase பண்ணா என்ன ஆகும்? Cost of capital. IRR cost of capital always we need to match. Right. Okay. So if you take the same project under different capital budgeting techniques, if you take the same project under different capital budgeting techniques, there may be different result. So one technique will say will ask you to accept, the other technique will ask you to reject. It doesn't mean that the technique is wrong, right? Only thing the perception of the manager, the finance manager, the controller, and the treasurer need to have. So the companies, according to their company standard, they will apply which method should be the best, right? Even when I was working at Hosur, I said, no, we applied for a loan, bank loan for investing in car, investing in school bus. There, when we prepare the project, we applied the IRR and NPV, right? How it equates, how it helps us to repay the money along with the interest without any difficulties. So we need to write a report as a treasurer. That we need to write a report and then facilitate it. So we calculated and forecasted. We determined the IRR and NPV. Then we proposed. So that's how. So dependent and independent project is go through what is mutually exclusive project, which means one decision will not affect the other decision. It's called a mutually exclusive project. Then what is the second step? We are in the first step in capital budgeting. What is the first step? Do you remember? Yes, there are 5 steps. The second step, we need to estimate the potential problems under mutual exclusive projects. Right? So there are 3 potential problems we used to come across. One is scale of investment, and the second one is cash flow pattern, and the third one is project life. Right? So scale of investment, what is that? Cash flow pattern, what is that? Right? Project life, how it discriminates the decision. So scale of investment. Scale of investment. So for example, one project requires an investment of 100 rupees. The other project requires investment of 1 lakh. So for this, if you compare, then you will end up in the wrong result, right? So that's called this gives you, what is that? This gives you the problem. Yeah. If you evaluate these 2 projects, this gives you a problem. It seems to be project 1 is best, right? Because it gives a huge good number of amount of return. So from IRR perspective, small project is good. From the NPV and profitability index perspective, large L project is good, right? So the scale difference makes you to differentiate to get different amount of return. Second, cash flow pattern. So if you see the project D and project I, there are 2 projects here. If you see the project D, first year itself it gives 1000, second year it gives 500, third year it gives 100. But if you take project I, first year it gives only 100, second year it gives 600, third year it gives 1080. The one project is in decreasing return and the other project is in increasing return. So this cash flow pattern also affects the decision, right? So for example, if you see the project D and I, IRR, NPV and profitability index, it seems to be same, but IRR only differs, right? So I will end up with a confusion on how to select. So please go through some of the things. The third one, project life difference, right? For example, project X has 3 years life difference, but project Y has only 1 year life. Okay.
Yes, sir. Now it's audible, sir.
Now it's audible. Okay, thank you. So what is that?
Yes, sir. Thank you.
Thank you. So what is that? Project X has 3 years life and the project Y has only 1 year. So you can't compare these 2 by using capital budgeting technique. So this likewise you need to have 3. There used to be 3 problems as we have discussed earlier. So yeah, scale of investment, cash flow pattern, and project life. This has to be uniform when you compare the projects, right? So this is in capital budgeting. Then the 4th step in the capital budgeting technique is capital rationing, right? What is capital rationing? This used to be on net question earlier. So capital rationing, even circular capital rationing occurs when a constraint or a budget ceiling is placed on the total size of capital expenditure during a particular period. Right? That's called the capital rationing. For example, I have 10 lakhs amount, right? So I have 12 projects to invest. Out of 12 projects, I have shortlisted 5 best projects. 5 best projects, right? All the 5 best projects together it needs 12 lakhs, but I have only 10 lakhs. Then how will I divide that into 5 projects? Shall I equally divide or shall I divide according to the rate of return which it gives? So how do I divide? How do I rank the project? So the entire exercise is called as capital reasoning. The entire exercise is called as capital reasoning. So for example, here Julie Miller, he has to undertake a basket wonder project. She limited maximum expenditure 32,500 only for this budgeting period, 32,500. But they have different varieties of projects like A, B, C, D, E, F, G, H, I, like that varieties of project. Initial investment, IRR, NPV, profitability index they have calculated. Then they are going to, now they need to limit with 32,500. So most of the projects are profitable projects. They have shortlisted. But how to divide this 32,500 into the A, B, C, D, E, F, G, H project, right? So accordingly, they need to get into the process and best select the best project and shortlist, rank that. Finally, they have set project C, F, and E have the three largest IRR. Whichever has the largest IRR, they have selected first three, and it is called as C, F, and E. But its total investment 27,000. But they need only 32,000. They have only 32,500, but they need only 27,000. Then remaining 5,500 has to be invested in some other project. This is one way they have ranked. The other way, if you choose by NPV, net present value, if you choose that, so there are only two projects it comes, F and G, which means it requires only 28,500, but with the availability of 32,500 outlay. Right. So if you choose by profitability index, so you can choose project F, B, C, and D. 4 projects you can choose because it has highest profitability index, right? Okay. So accordingly, you need $38,000 to invest, but we have only 32,500. So there is a constraint. So to manage this constraint, we need to rank now. Now what we need to do as a consolidation, profitability index based funding, FBCT and D project would be best 38,000. If you apply NPV, F and G would be best 28,500. Likewise, if you take IRR, CF and E would be best 27,000. So here the profitability index generates the greatest increase in shareholders' wealth. That is the most important. Whatever the method you apply, so whether the shareholders' wealth is increasing or not, wealth maximization as an objective, as a core objective of financial management, is that meeting or not? If yes, then that method would be best. Those projects would be best to invest. Right. Then there is a concept called sensitivity analysis. Sensitivity analysis. Sensitivity analysis means you need to apply what if condition. What if condition. For example, what is that? We used to have optimum cash flow, favorable, most favorable, least favorable, and moderate cash flow. Right? Sensitivity. So in the same period, in the same project, we need to apply. The last step in capital budgeting is post-completion audit. There's a formal comparison of the actual cost and benefit of the project with original estimates. So we have applied the NPV, IRR, and every method. We decided to invest. Then we applied all the uncertainties, risk and uncertainties. Then we shortlisted. Then we compared with the available amount through capital reasoning. We decided some particular project. Then we invested. We have run through the project. We have gone through. After 5 years, we would like to have post-completion audit. During this post-completion audit, we will examine whether our decision is exactly went off or wrong. Then we will analyze. That's called the post-completion audit. It helps us to decide better in the future. So next, financial planning and investment decision helps us. This helps us to make best, right? So these are all as capital budgeting decision, or otherwise called investment decisions. The next part is liquidity decision. So here there are 3 types of management. There are 4 actually, but here purposely I have excluded the cash management, right? So there are 3: working capital, receivable management, inventory management, and the last one is cash holding period, or you can say cash management, right? So liquidity decisions. So financial management, I would like to recap again since Stella I'm joined a little late. So financial management core subject is narrowed down subject. If you're thorough in financial management, 10 out of 10. Sure. 10 questions you can answer 10 out of 10. So if you take marketing, human resource management, accounting, it's all wider area, right? You need to study nook and corner and update what is the current. But if you take international business, financial management, this kind of subject, it's narrowed down, it's limited, border, right? With a small border, just cover entire thing in international business. And even international business little difficult because you used to study only few sum. You must have studied only in few sum, but financial management is at least you must have come across more than that because it includes sums in your descriptive exam, right? So you must have remember most of the things. So please cover the entire financial management. The entire financial management has only 4 types of decisions: financing decision, investment decision, liquidity decision, and profit allocation decision. So financing decision, first one deals with capital structure and cost of capital. The second, investment decision, deals with capital budgeting techniques. The third one, liquidity decision, deals with working capital management, receivable management, and inventory management. That's what we are going to look into now. The last one, dividend, the profit allocation decision, deals with dividend distribution, right? Dividend theories, dividend distribution models, right? So that's it, the entire financial management. Before that, there are some introductory part. What is financial management? Who is called a financial manager? What are the role of financial manager? Treasurer role, controller role. Then what is the objective, the goal of financial management? Profit maximization, wealth maximization. What are the critics of profit maximization? What are the pros and cons of wealth maximization? What is economic value added benefit? What is EV value? Then what is those things are introductory part. That is also must. Scope of financial management, nature and scope. Whatever the subject you study, please go through the nature and scope of that particular subject. Because கண்டிப்பா அதுல இருந்து ஒரு கொஸ்டின் இருக்கு. Statement validation model or assertion reduction model அதுல இருந்து கொஸ்டின் இருக்கும். Please take down the because of, why, or hence, there, henceforth, அந்த மாதிரி therefore, அதில் அந்த மாதிரி வர்றது எல்லாமே please underline and study. The study material which we circulated, please go through like that, right? Or even if you build your own study material, if you have your own backup, please go through there from the net question model, right? So now the third decision is liquidity decision. So here we will discuss about working capital management, receivable management, and inventory management in a quick way, right? Yeah. So what is working capital? There are different kinds of working capital. So it is categorized based on concept and based on time. So based on concept is simple: gross working capital and net working capital. Gross working capital is also otherwise called as, we used to call in simple form, current assets. Total of current assets is called as gross working capital, and current assets minus current liabilities is called as net working capital, which we discussed in last class in accounting. Do you remember that? In management accounting, fund flow analysis, we discussed this. Then the second category is on the basis of time, which means permanent or fixed working capital. The other way, temporary or variable working capital, right? So permanent and fixed working capital also has 2 types. One is regular working capital and the other one is reserve working capital. Temporary or variable working capital has other 2 categories: seasonal and special working capital, right? Please have all the types and remember please get into the meaning, right? So don't assume based on the content, based on the name, right? So there is a concept called working capital cycle, even like accounting cycle, cash flow cycle. The working capital cycle is also called as cash flow cycle, right? Cash, actually the investor comes and starts a business and brings capital in the form of cash, right? He invests into the business. He buys raw material, right? Raw material. Then the raw material goes to factory. It becomes as work in progress. After factory, it becomes as a finished goods, comes to the store and goes to the sales, market. So the sales usually happen either cash sales or credit sales. So if it is credit sales, it goes to debtors. So after going to debtor, the debtor may transfer his debts to other by through bills of exchange, then again in the form of debtors. Then they will repay the amount. This is called working capital cycle, right? In which period, how it becomes what from, for example, this is, take for example, this is 18th December. Sorry, today is the 19th December. 19th December it starts. So, on which day it comes back in the other form of cash. Right? This is called working capital cycle, or similarly we also call it as operating cycle. Similarly, we also call it as operating cycle. So here you have four things, four components: raw material conversion period, working capital, work in progress conversion period, finished goods conversion period, receivable conversion period. This is called gross operating cycle. If you add all, this is called gross working operating cycle. If you subtract the payable conversion period, the payable conversion period, PCP, payable conversion period. If you subtract that, then you will get net operating cycle. This helps us to determine the exact working capital. Right? So this is also one method. There are different methods to determine the working capital. Balance sheet method, right? Accumulate and current assets and current liabilities method, and then income statement method. Through the sales and profit, you can determine the working capital, and then through trend analysis, you can determine the working capital. Regression equation model, you can determine the working capital. There are varieties of models: statistical model, accounts model, financial based on financial statement. So this is a unique model, operating cycle model. Right? That's why we discuss a lot in operating cycle. Right? So the last decision is liquidity decision. It deals with profit distribution. Sorry, receivable management. Sorry, we are in liquidity decision. I did not. I thought it's last. We have liquidity management. We have discussed the working capital management as of now. The next one is receivable management. Yeah, receivable management is nothing but debtors, bills receivable, and how do we receive, right? Ratio analysis, we used to apply debtors turnover ratio, creditor turnover ratio, working capital turnover ratio. How efficiently you are using that, right? So working capital turnover ratio can be applied to assess the efficiency of working capital rotation in the organization. That comes in working capital management. Receivable management, we used to calculate debtor turnover ratio as well as the creditor turnover ratio. Debtor turnover ratio, for example, 12 times, right? Creditor turnover ratio is 10 times. So is that efficient? We need to compare. Or for example, debtor turnover ratio is 1 month. Creditor turnover ratio is, 45 days, 1.5 months. Then is that efficient? Yeah, then we need to say, yeah, it is efficient. How it is efficient? Because as per the common sense, whatever we need to receive yearly, and whatever we need to pay little late. This is the common sense, right? The same common sense applicable in business. So in debtor turnover ratio, debtor's velocity has to be yearly. We need to receive as much as yearly as possible, but we can pay little later. So debtor velocity, if it is 1 month, creditor velocity 45 days, that is for 1.5 months. That means you are receiving yearly and you are paying late. So this is efficient receivable management. This is efficient receivable management. If it is in reverse, right? We are paying once in 45 days and we receive once in 60 days. If that is the case, then your efficiency is questionable. You need to improve your receivable management of inward. So that's how you need to apply the ratio analysis here in the entire liquidity decision, right? Here, traditional credit analysis covers the 5 C's and the 6th one as a past experience, right? Please go through. This is the theory part: character, capacity, capital, collateral, condition. So all the things plays a role in deciding the debtor's velocity and creditor's velocity. Yeah, these are the different monitoring tools of accounts receivable. Yeah? As I said, receivables turnover, receivable debtor velocity, debtor's turnover ratio. Then average collection period. Here it is called period. Yeah, we used to say. Then aging schedule. Aging schedule used to be done by financial institutions, banks, to collect their debts. Then collection matrix. It's nothing but period. We used to calculate, we used to frame a period to collect the amount. Right? Receivable turnover is simple. Apply the ratio and calculate. As I said, always compare with payable turnover. That means creditor turnover ratio. Then average collection period, as usual, we used to calculate in number of days or months in weeks, all the credit sales, right? Average collection. Then aging schedule. So statement showing age-wise grouping of debtors or breaking up of debtors according to the length of time for which they have been outstanding. So as I said, it used to be applied by banks and financial institutions. For example, less than 30 days. So what is the amount outstanding? Right? Then less between 31 to 45 days, what is the amount outstanding? 46 to 60 days, what is the amount outstanding? Above 60 days, what is the outstanding? So altogether, what is the total outstanding amount? So here 1 crore is the total outstanding amount, 40 lakhs in less than 30 days, 20 lakhs in between 31 to 45 days. Likewise, they have scheduled. Then they have calculated the percentage, the proportion, 40 lakhs divided by 1 crore, 20 lakhs divided by 1 crore into 100. They have calculated the percentage. So huge percentage falls in less than 40,000, less than 30 days. Yeah, modern, the high percentage falls in the less than 30 days. That means their receivable management is good, efficient. Yeah. For some part, 32nd rank goes to the 46 to 60 days, which means it has to be in control. It has to be in control, right? It has to be moved. So which part is efficiently they are repaying, which part is lacked in repayment, you can identify by using this aging schedule, right? The last one is collection matrix. Yeah. So January, February, March, what is the selection? What is the sales happen? And month of the sale, and what is that happen? First month, how much they could collect. Second following month, how much they could collect. Third following month, how much they could collect. Can you see the trend now? Can you analyze that? The based on that, you can mark. You can have a red circle to to measure the inefficiency of debt collection. Usually, it used to be handled by factoring agents or the notary public. What happens in factoring? Factoring, international business role and the concept of factoring, right? Which means I have a factoring. Even bank used to do, merchant banking used to do factoring. If I have huge receivables, I will not struggle a lot. What I used to do, I used to appoint a factoring. Yeah, I will appoint a person as a factoring. I will convert all my receivables to them. They will take rights to collect the amount. So some amount I will pay them as a commission, right? So they used to follow this collection matrix, right? They used to efficiently follow. So what is the purpose of factoring? You can avoid bad debts, you can avoid any doubtful debts, and you can avoid, instead of investing a lot of money for collecting your debts, right? So international business, there is factoring plays a major role because the exporter will not have an investment to collect money from various countries wherever he sent. So even the consignment business, they used to appoint factoring to collect the money. Right? The last one is liquidity decision. Yeah, here we used to discuss the inventory management under liquidity decision. The third decision layer. The other one is inventory management. So here we deal with stock. Yeah? So here some of the key terms we need to understand. Lead time, what is lead time? So time interval between ordering and receiving the order is called a lead time. What is the carrying cost? Carrying cost is also called as holding cost. So did we come across this earlier? Yeah. EOQ calculate purpose we have come across holding cost. Please go through that. What is carrying? I said carrying is not bringing the goods to your place. Carrying means the amount of investment for a particular period, how much it carries as an opportunity cost, those things it includes. It includes insurance, so security, insurance, what is that, storage cost, yeah, and rate of foregoing interest, everything it includes. Then ordering cost of ordering and receiving the inventory. Here you can include transportation, installation, and bringing the goods to your place, carriage, freight, etc. Then shortage cost when demand exceeds the supply. Shortage cost, it plays an important role. Shortage cost can be reduced by using the logistics, the effective logistics and supply chain management. So logistics supply chain, but the marketing the question, it reduces the shortage cost. It nullifies the shortage cost. There is also a concept called bullwhip effect. Please make a note. Bullwhip, BULLWHIP, WHIP, bullwhip effect. which means in logistics and supply chain, in inventory like transfer, raw material or the goods when you transfer, there are varieties of parties involved in between. As we discussed in marketing channel of distribution, level 1, level 2, level 3, there are n number of middlemen included. So everyone will say one order in different numbers. For example, consumer will say 10 pack, the retailer will buy 15 pack. If the retailer buy 15 pack, altogether the wholesaler, if you count there are 10 retailers, 150 the total order, the wholesaler will buy 200. The wholesaler will order for 200 packs. So if you calculate everything, there is a huge excess in between. The excess is called as bullwhip effect in the logistics and supply chain management. The chart in that chart it used to be bullwhip effect, right? The bullwhip effect increases the cost of holding the goods, right? Cost of holding the goods, cost of carrying the goods, right? Cost of ordering it increases, right? This is opposite to shortage cost. Okay, so shortage cost is when the demand exceeds the supply, the shortage cost arises. If you have any excellent inventory management technique in your organization, you can reduce the shortage cost, right? Then ABC, what is ABC analysis? Always better control. So activity-based costing is that there is also a activity-based costing in cost accounting, but APC from the inventory management perspective is always better control. We used to say high value, limited number of quantity, then keep it as in A column, A. Then moderate value, but moderate quantity, keep it in A, B. Least amount, but huge quantity, keep it in C. Right? That's what this chart also says. Always better control. There is another concept called cycle counting. Cycle counting, which means the raw material gets into factory as then converted as work in progress, then again converted as finished goods, then goes to packing, then goes to market, then again it used to be we need to buy raw material. That's called cycle counting, right? A physical count of items in inventory, cycle counting. Cycle counting management, how much accuracy is needed? So we need to know cycle counting to be performed, when it has to be performed, who should do it. So these are the questions need to be answered for the cycle counting in a factory, right? The next model is economic ordering quantity. So economic ordering quantity is model, as we have discussed earlier, EOQ model, right? The order size that minimizes the total annual cost. The total investment in the inventory, total ordering cost, total carrying cost. If you balance the ordering cost and the carrying cost, there is one equation point. The equation point in which the number of quantity comes, the quantity is called as economic ordering quantity, right? The order that minimizes the total annual cost altogether, right? The other model is called EPQ, economic production quantity model, right? And quantity discount model. So these things it comes under inventory management. Please go through the assumptions of EOQ model. This used to be in questions also. Then inventory cycle, as I said, no counting, cycle counting. So how there is to be a different points of order, commerce level, costing level, reorder quantity, reorder level, maximum level, minimum level, average level, inventory management level. You remember that? If you know, yeah, you can see reorder level, receiving level, placing order, reorder point, usage rate. So there used to be a bell-shaped curve. It won't be exactly the straight slope curve. It used to be bell-shaped curve. When you can order, right? So how to calculate the total cost? So annual carrying cost and annual ordering cost, right? That's called total cost. Please go through that, some of the charts. And this is the EOQ formula which we discussed already in earlier classes, in accounting classes we discussed. Right? Please have this equation in your mind. Don't have this equation. You know? Letters may be different in different textbooks, but the explanation can't be different. And what is minimum total cost? That's what I said. The carrying cost equalizing the ordering cost. If you equalize these things, you will get this formula. This formula is arised from this equation only. Right? If you just equation Q in the side position, Q square I don't. Then 2 take the 2 in this side, hash to the other side. Only Q alone should be this side. Which allowing the side one. If you do that, you will get EOQ formula. Then economic production quantity. What is that? The same thing like EOQ, but EOQ is the ordering part. Here it is the how many quantities to be produced, not to hold much. right? Finished goods, total. So it has to be dispatched as and when it has been completed. So that's called the production quantity. Here also the same model they used to use. The basic concept is same, right? So here some of the assumptions which go through. That's most important. Assumptions plays an important role, right? The economic run size, which means the quantity at overall quantity. So where we use production quantity and ordering quantity all together, yeah, total cost with purchasing cost. Please go through this. When to reorder with reordering quantity. Reorder point means safety stock, service level. Please go through these things. Safety stock, reorder point, right? And determinants of reorder point. These and all has been asked, right? Net question like please go through inventory management perspective. Right? So this chart helps you when to reorder the material. So if you can see the safety stock. Then there are different models to reorder. There is a fixed order interval model. The other one is different. That means variable, varying order. Please go through that. Benefits and advantages. Single period model. The one is fixed cost interval model. The other one is single period model. Only one time there is an order. Right? Pharma company, if you take only one time order, right? Single period model. So it also arises shortage cost, excess cost, like carrying cost and ordering cost. How we balance the same way we need to balance these two to get single period model, right? To get number of quantities to order under single period model. Then single period model, there are two levels: continuous stocking model and discrete stocking model. Please get to know these things. Let me go to next one. Right, too much inventory, then what are the strategy you can apply? The next one is the last one in the financial management, dividend decision, profit allocation decision. Profit allocation decision. This is repeated. There are theories are there, dividend theories, right? There are Walter model, Gordon model, approach, right? Relevant. That those things we need to see. What is dividend? How the dividends are calculated? Why do they more dividend? Why do the company need to pay more dividend? Why not to pay more dividend? Other reasons are there. So one person says pay dividend more. One person says retain more. The other person says balance both. Then the fourth model also says in one particular time pay more dividend. If in different time they say different time how to calculate that. So during that time retain more and pay less dividend. Right? Like that it says. Well, let us discuss that, right? So dividend decision valuation of the firm. These are interrelated. If you pay more dividend, your market share will increase. Right? This is one theory. The other one says, no, don't pay much dividend. Retain the business itself. Invest in the business itself. Get more amount. Your wealth increase your wealth of an organization through asset building. Thereby, your value of the share can be increased. That's the other school of thought. So one school of thought says dividend decision does not affect the shareholders' wealth. Dividend value of shareholder will not get affected. Even if you retain, it is going to increase their wealth only. Your company's wealth increases, thereby their wealth also will increase. So dividend distribution will not affect their share value of the firm. The other school of thought, what they say is dividend decision materially affect the value of the firm, shareholders' wealth, right? So that's how they used to divide irrelevant model and the relevant model. Relevant model means it has the relationship between dividend declaration and value of the firm. Irrelevant, there is no relationship between the settlement of payment of dividend and value of the firm, right? So theory of relevant, theory of irrelevant. We need to know who said this. Irrelevant theory and anarchy, relevant theory and anarchy. Right now, one is the theory of irrelevance. The first theory is called the residual theory. Right. This theory regards dividend decision merely as a part of financing decision. It's not investor. It's not what is that? It's not profit allocation decision. It's a part of financing decision. Financing decision and other capital structure and cost of capital. There you can have, because the earnings available may be retained in the business for reinvestment. So for this purpose, residual theory says, right, it is a part of financing decision you no need to have a critical role to be played in investment in dividend decision, right? If the funds are not required in the business, then you can distribute as a dividend. Simply they say, when do they distribute, when do they not? So it is nowhere is going to affect your firm. If your firm needs funds, instead of pricing through debenture, instead of issuing new shares, retain the existing profit, retain the profit gained, do not distribute the dividend. If you do not need any amount, then whatever the profit gained, you can distribute as a dividend. That's what the residual theory says, right? The other theory, so famous theory, Modigliani-Miller theory. Do you remember the full name? There are two people. Yeah, please have the full name, which is there in the earlier slide. So according to this approach, dividend policy has no effect again. Is irrelevant. This is also irrelevant model. No effect on the market price of the share, right? It is determined by the earning capacity of the company. It is not because of the investment policy. What is that? Retainment of the investment policy, right? So it is based on the earning capacity of the firm, and it is based on the investment policy. Okay. So what they say, some of the assumptions, when there are a perfect capital market, not transparent capital market. Share price increases, decreases, it used to be decided by the capital market, share market. If it is perfect, then you can very well say that your dividend distribution does not affect the value of the firm, right? Investor behave rationally. Immediate heavier invest பண்றது, immediate get back பண்றது, அந்த மாதிரி இல்லாம, if they behave rationally, then this model can be better, right? So likewise, please go through there is no risk or uncertainty. So in the matter, these assumptions are most important, particularly the MM approach. Then there are few arguments in MM approach. Critique is also most important. Please go through the critics. Then the next, please go through this is an interesting example. If you remember the example, you no need to remember this argument, because if you remember this example, everything is based on this argument. Yeah, no need to memorize. Then how to calculate the value of the firm? They have based on the dividend distribution. So he has given an equation, mathematical equation. Please go through that. Yeah. So these are the criticisms of MM approach. So due to this, the next approach has come. These are called as relevant theory. So relevant theory, there are different people have been given. So popular model are Walter and Gordon model, James Walter and Myron Gordon. And there are the other model, Richardson model, Linker model. Please get to know the name. Sometimes there used to be an option. Walter and Gordon option le illama, which of the following is the relevant model of dividend decision? John Linter or Richardson can be the one of the name, one of the options, right? So we need to know all the options, please. Next, let us discuss Walter and Gordon's approach, because these two are dominant in relevant theory, relevant model, right? So what Walter says is so interesting. He says he studies the relationship between IRR and cost of capital. IRR and cost of capital, internal rate of return and cost of overall capital, weighted average cost of capital, to determine the dividend policy. These two are based on the Walter's approach, right? What he says, if the IRR is more than the cost of capital, then you can say it is a growth firm, growing firm. This firm can retain its own income, which means the optimum payout would be zero. Dividend you can retain whatever you earn during that particular period. So if the IRR is more than cost of capital, then it can be called as growth firm. It once asked in match the following, right? Outside on the IRR is greater than K, IRR is less than K, IRR is equal to K. They have the other side, they have clubbed the growing firms, moderate firm, right? Less growing firm, likewise. The payout ratio 100%, 0%, more irrelevant. Likewise, they have decided. Okay, match the following name on the assets and reason layer. And then what is that? Statement validation model. This question is repeated most time from this area, right? If the IRR is more than cost of capital, then payout ratio would be zero. No, don't need to pay. You can retain everything. If the IRR is less than K, then your optimum payout would be 100%. You can pay entire thing as a dividend. No need to retain a single penny. If the IRR is equal to K, then it comes to irrelevance theory. If IRR is equal to K, cost of capital, then it again goes back. Relevant theory now. First 2 points related to relevant theory. If this happens, it goes to relevant theory, which means it will not affect the value of the share. Whatever you want, you can give as dividend. It will not affect the value of the firm. Right? Shareholder will get the same return from the firm as expected by them. Right? So likewise, he has said Walter model. So for this decision, what are the assumptions he has? Right? So please go through the assumption. Every assumption has the background. So for example, the firm has a very long life. Long life firm da idellame assess panna mudiyum. Right? If there is only 2 years old firm, you can't have this Walter model. So likewise, every assumption has its background. So, Walter model, there is a formula. Please go through the ones they ask the sum also. Once or twice they ask the sums also. Right? To calculate the price of equity shares equal to dividend divided by cost of equity minus growth. So likewise, please have the formula. Then criticisms of Walter model. Right? And then Gordon's approach. Myron Gordon, his full name is Myron Gordon, has developed a model on lines of Professor Walter. But he says different assumptions. Gordon's assumptions are different. What he says, please go to the app. Yeah. See, the firm is in all equity firm, right? No debt, no long-term debt. Retained earnings represent only the source of financing investment program. The rate of return of the firm's investment is constant. So likewise, he has built up some important assumption. The G, growth rate is equal to what is that rate and the retention ratio and payout ratio. If you multiply rate, cost of return, cost of return and payout ratio. If you multiply, you will get the growth rate. Right? And then the cost of capital of the firm remains constant and it is greater than the growth rate. It's always like this, right? Please go through the formula. It helps us to calculate. Right? Then factors influencing dividend policy. There are n number of factors. You need to know the background. Right? You need to have the explanation for this. Right? The types of dividend, and forms of dividend, regular dividend, stable dividend, the types of then forms of dividend. Please go through every type and advantages. Dividend policy in practice. Forms of dividend, profit dividend, liquidation dividend, interim dividend, final dividend, monthly dividend, interim dividend. Interim dividend is different from semi-annual. What is that? Semi-annual, half-yearly dividend, right? So interim dividend, half-yearly is not both the same, right? Interim dividend can be anywhere in between the year, in between to AGM. If you declare any dividend, it's called interim dividend. Right? Then the basis of medium, cash dividend, scrip dividend, or bond dividend. What happens? All dividend used to be accumulated and issued as debentures. That's called bond or scrip dividend. Then property dividend. Sundar Pichai has got property dividend from his company. Then stock dividend. It's issues bonus shares. Stock dividend is nothing but issuing bonus shares. So accumulate all the retained earnings and convert the retained earnings as a share capital by issuing stock dividend. It's called as bonus shares, right? Yes, so this is all financial management. So as of now, we discussed 4 decisions, introductory part and 4 decisions in depth in an outline we have discussed. Please get to know that I will